Welcome to the Deep Dive, where we cut through the noise and get straight to the insights that matter. Today, we're plunging into one of finance's most enduring and, for many of you, perhaps familiar mysteries, the equity premium puzzle.
hmm
It's that persistent, historical observation of stocks consistently outperforming safer assets by a margin that traditional economic models simply haven't been able to account for. It challenges our fundamental understanding of risk and reward itself.
It really does.
But what if the answer to this decades-old conundrum lies not in exotic financial instruments or complex investor psychology, but in something far more fundamental to our economy and our daily lives, something as tangible as how wages behave and how our labor markets actually function?
Yeah, moving beyond just finance theory into the real economy.
Exactly. Your mission in this deep dive is to gain a rapid yet comprehensive understanding of a groundbreaking new model. This isn't just about solving a single puzzle. It's about profoundly linking the abstract world of asset prices to the very real-world dynamics of our economy, encompassing everything from unemployment fluctuations to the deep, often unsettling, mechanics of business cycles.
Right, it's trying to build that bridge. It's a complete rethinking of how we perceive and price risk, really.
We're dissecting a recent, highly influential paper from the Journal of Financial Economics by Hang Bai and Lu Zhang, aptly titled Searching for the Equity Premium, alongside its comprehensive Internet appendix.
And it's important that appendix adds a lot of detail.
Absolutely. And this isn't just theoretical speculation. This research presents a unified theory of asset prices and business cycles, built upon extensive historical data drawn from 17 developed countries, spanning over a century from 1871 to 2015.
That long historical data set is key,
Okay.
It gives it real weight.
It really does. This vast data set allows them to rigorously test their model against a wide array of economic conditions and historical events. Over the next while, we'll uncover insights that I think you'll find genuinely surprising. We'll begin by truly grappling with this historical puzzle, then introduce the innovative model that aims to solve it.
Yeah, set the stage first.
From there, we'll zero in on the utterly surprising and powerful role of wage inertia, the stickiness of wages in driving financial outcomes.
That's a big piece of it.
We'll also confront the staggering reality of endogenous disasters, economic downturns that aren't just external shocks, but systemic breakdowns arising from within the economic system itself.
Which is quite a profound idea.
Definitely. Finally, we'll see how this integrated perspective connects to everything from predicting stock market movements to reevaluating the immense welfare costs of economic downturns. It's a journey into the heart of macro finance, and I think it will profoundly shift your perspective. Let's dive in.
Okay, let's do it.
So let's start by defining the core conundrum. The equity premium is fundamentally the historical average difference between the return on the stock market and the return on a relatively risk-free asset, typically a short-term government bond.
Right, stocks versus something safe like T-bills.
Exactly. What's been consistently observed over more than a century of data across numerous developed countries is that stocks deliver a surprisingly large premium.
Yeah, surprisingly large is the key phrase. For instance, the extensive historical data utilized in this very paper, averaged across the 17 developed nations from 1871 to 2015, reveals a leverage-adjusted equity premium of approximately 4.36% per annum.
4.36% per year.
Per year, on average, for over a century. Think about that. On average, for over 100 years, equities have significantly outperformed bonds by more than 4 percentage points annually.
And that's precisely where the puzzle aspect truly bites, isn't it? Because such a large, persistent premium isn't what traditional, well-established economic theory would predict. Why does this observation clash so dramatically with our models?
Exactly. This discrepancy was first vividly highlighted by Mara and Prescott back in 1985. Their seminal work demonstrated that standard economic models, the kind that assume rational individuals striving to smoothly consume over time by saving or borrowing, predict a negligible equity premium, often close to zero.
Almost nothing.
Pretty much. The intuition is straightforward. If individuals can easily smooth their consumption across different economic states, they shouldn't demand such a high premium for holding risky stocks.
Right. If your lifestyle doesn't change much whether the market booms or busts, why demand huge extra returns?
Exactly. If your consumption barely fluctuates whether stocks are up or down, why would you need a massive return to hold them? The existence of this puzzle strongly suggests there's a fundamental risk, a deep-seated discomfort with economic uncertainty that these traditional models simply aren't capturing. It leaves economists truly perplexed.
So it's almost like the established models are saying people are essentially indifferent to stock market risk because they can always adjust their spending to compensate. But the market itself, through these high returns, is clearly screaming, no, we care deeply about this risk and we demand significant compensation for bearing it.
That's a great way to put it.
Yeah.
It implies a fundamental misunderstanding of what truly constitutes risk for investors in those standard frameworks.
And this puzzle didn't just highlight a quantitative mismatch.
Yeah.
You're saying it exposed a bigger issue, a methodological flaw.
Precisely. This puzzle didn't just highlight a quantitative mismatch, it exposed a significant methodological flaw in how the fields of finance and macroeconomics had been developing. The authors refer to this as a macro-finance dichotomy. For decades, these two crucial branches of economics operated in surprisingly separate paths, almost in completely isolated silos. Finance models often resorted to what we call exotic preferences, essentially, making individuals extremely risk-averse in ways that aren't easily grounded in real-world behavior, or they would simply assume exogenous cash flow dynamics.
Meaning they just plugged in numbers for profits without explaining why.
Exactly. This meant they'd plug in how corporate profits or dividends behaved without explaining why they behaved that way. These models could be tweaked to match asset prices, sure, but they often completely ignored the real economy's production side, how firms actually produce goods, hire workers, and invest.
And meanwhile, macroeconomics was looking the other way.
Indeed. Macroeconomic models, on the other hand, focused on full-fledged general equilibrium production economies, complete with intricate interactions between households and firms. They aim to understand business cycles, unemployment, and GDP fluctuations.
So the real economy stuff.
Right. But they used primitive preferences, meaning simpler, more standard utility functions, and largely ignored asset prices altogether. They could explain how a recession happened, perhaps, but not necessarily how that recession impacted stock valuations or bond yields.
So you had these big gaps.
Huge gaps. This created significant unaddressed gaps in our understanding. We were left with fundamental questions that neither field in isolation could adequately answer. What are the deep microfoundations underlying those often complex cash flow dynamics assumed in finance models? How do the tangible elements of the production side of the economy, things like labor markets and capital investment, actually drive asset prices?
Right.
To what extent do time-varying risk premiums quantitatively impact macroeconomic dynamics? And critically, how large is the true welfare cost of business cycles in an economy that can genuinely explain the equity premium? These were all largely unanswered questions, a direct consequence of this academic fragmentation.
So if the old way of thinking left finance and macroeconomics in separate universes, this groundbreaking new research takes on the monumental task of bringing them together, of creating a truly unified theory. That sounds like an intellectual Everest. What's the innovative framework they're employing to bridge this chasm?
Well, what's truly fascinating here is that the authors don't just patch up existing models, they construct a comprehensive framework from the ground up, designed specifically to integrate these previously disparate elements. They begin with a dynamic stochastic general equilibrium, or DSGE, framework.
DSGE.
Think of it as building a sophisticated miniature digital economy, a fully fledged computer simulation. It explicitly represents all the interacting households and firms, allowing for endogenous variables.
Things determined inside the model.
Exactly. That is, things that are determined within the model through the complex decisions and interactions of the economic agents themselves, rather than being simply assumed or imposed from the outside. This capacity for internal determination of variables is absolutely crucial for understanding the intricate feedback loops that characterize a real economy.
So it's not just plugging in numbers into a formula, but rather building a self-contained, evolving universe to see how everything truly interacts and influences each other from the ground up. That's ambitious.
It is very ambitious, and within this DSGE, they incorporate a more advanced way of modeling human decision-making. Recursive utility, a concept pioneered by Epstein and Zinn and Weil.
Recursive utility. Sounds complex.
It is a bit, but the core idea is powerful. This isn't your standard everyday utility function.
Yeah.
Crucially, it separates an individual's willingness to substitute consumption across different periods, for example, choosing to consume more now versus saving and consuming later from their pure aversion to risk.
Why is that separation so important?
Because it allows the model to capture a profound aspect of human behavior. Individuals might be quite willing to accept lower average returns for assets that provide genuine protection against rare, severe economic downturns, even if they aren't particularly risk-averse to everyday, minor economic fluctuations.
So it captures that fear of really bad times, the big
Yeah,
crashes.
precisely. It's a nuanced way to model that deep-seated primal fear of catastrophic losses, that desire for disaster insurance that simpler models often miss.
And then they layer on something from labor economics, which sounds like where the real breakthrough might be.
Indeed. A critical and truly innovative addition is the concept of search frictions, drawing upon the Diamond-Mortensen-Pissarides model, a cornerstone of labor economics.
Nobel Prize winning stuff,
That's
right?
the one. This is where the real-world dynamics of our working lives and employment come into sharp focus. It explicitly models how unemployed workers search for jobs and how firms post vacancies to find suitable candidates. This isn't an instant, frictionless process where jobs magically appear and workers instantly fill them.
We all know that from experience. Applying for jobs, trying to hire someone. It takes time.
Absolutely. You know this from personal experience, right? Whether you've navigated the job market yourself, sending out countless resumes and enduring multiple interviews, or if you've been on the hiring side, trying to find that perfect fit for a specialized role, it's rarely immediate or effortless. This model beautifully captures that fundamental reality. It involves time, effort, and significant costs. These are the frictions.
Okay.
This framework naturally introduces dynamic variables like the job finding rate, the job filling rate, and the vacancy unemployment ratio, often referred to as labor market tightness, all of which are determined endogenously within the model, responding to the evolving state of the economy.
So these elements are not just assumed. They're part of the complex internal machinery that drives the economy's behavior.
Yeah.
And finally, the model also brings in capital accumulation.
Yes. The model includes firms that actively invest in new capital, such as machinery, factories, or technology. This is absolutely critical because it makes cash flow dynamics, particularly dividends, endogenous.
So dividends aren't just assumed anymore.
Correct. Unlike many prior finance models that simply assumed a process for dividends, here they arise naturally from the complex interplay of production, labor market conditions, wage negotiations, and investment decisions within the model. This is a huge step forward, providing a micro-founded explanation for why dividends behave the way they do, rather than just positing it as an external given.
So if we connect all these pieces, what does it mean for the holy grail that macro finance has been chasing, getting everything under one roof?
Well, the long-term objective of this research, and indeed of the broader field of macrofinance, is to formulate a unified equilibrium theory that can simultaneously explain both asset prices and business cycles in a coherent, internally consistent manner.
The grand unification.
Sort of, yeah. For decades, the main hurdle has been to explain the empirically observed high equity premium within a general equilibrium production economy while still accurately replicating observed business cycle dynamics like realistic unemployment rates and consumption volatility.
It was always one or the other.
Often, yes. Most attempts either succeeded at one or the other, but rarely both. This model, by intricately integrating recursive utility, search frictions, and endogenous capital accumulation within a DSGE framework, aims to clear that formidable hurdle, offering a truly coherent view of how our economy's real side, its labor markets, and its financial markets all interact and mutually influence each other. It's an ambitious synthesis.
So they've built this incredibly sophisticated framework, bringing together elements from different fields. But what's the actual secret sauce, the core mechanism within this model that allows them to finally crack the equity premium puzzle? And how does it relate to these endogenous dividends we just talked about?
Right, okay, this is where it gets truly pivotal. In many traditional general equilibrium production models, there's a persistent dilemma. Investment tends to be highly procyclical.
Meaning it goes up a lot in booms, down a lot in busts.
Exactly. What that means is it rises sharply during economic booms and falls dramatically during recessions. Now, dividends, conceptually, represent the firm's profits minus its investment. So if investment is extremely procyclical, it can inadvertently make dividends countercyclical.
Countercyclical. So dividends go up in a recession.
Well, not necessarily up, but they might fall less or even paradoxically rise during recessions as firms drastically cut back on investment spending.
And that, as we discussed, is precisely the opposite of what you need to explain a high equity premium. You need dividends to be inherently risky, to plunge in bad times, to justify that higher return.
Absolutely. If dividends are countercyclical, they essentially offer a hedge during downturns, which would lead to a lower, not higher, equity premium. This endogenous dividend problem has been a major stumbling block for prior production-based asset pricing models. It's been notoriously difficult to generate procyclical dividends without resorting to artificial assumptions.
So how does this new model overcome that then? What's the hero in this particular narrative?
The unexpected hero in this story is wage inertia.
Wage inertia. Sticky wages.
Exactly. This is the concept that wages don't immediately or fully adjust to changes in labor productivity or overall economic conditions. They're sticky. The model builds this into its core through a deliberate and precise calibration of two key parameters from the search and matching framework. First, a very low bargaining weight for workers, set at equals 0.015.
Low worker power, basically.
You can intuitively think of it that way, yeah.
Right.
Workers having very little power to demand immediate wage increases even when the economy is booming, or resisting wage cuts when it's declining. Second, a relatively high flow value of unemployment, B equals 0.91.
What does that represent, the flow value of unemployment?
This B essentially represents the value of being unemployed, perhaps the utility of leisure, the existence of robust unemployment benefits, or income from a flexible gig economy, things like that. When this fallback value is high, it creates a strong resistance for wages to fall drastically during a downturn, as workers might rather choose unemployment over accepting drastically lower pay. This combination fundamentally reduces how quickly and sensitively wages adjust to changes in productivity and economic shocks.
So wages aren't as flexible, say, as a company's raw material costs or its capital expenditures. They just don't move as fast, which means they act like a relatively fixed cost in the short to medium term for a firm.
Precisely. That's a great way to think about it. And this isn't just a theoretical construct for the model. The model implies a wage elasticity to labor productivity of 0.278.
Meaning how much wages respond to productivity changes.
Right. And this figure is remarkably close to a new historical estimate for the U.S. spanning from 1890 to 2015, which found it to be 0.267.
Wow, that's very close.
It is. This empirical alignment strongly supports the idea that wages have been quite inertial historically, especially when compared to more recent post-war estimates, which are somewhat higher, typically between 0.406 and 0.449. So the model's sticky wage mechanism has robust empirical plausibility over the long run, reflecting a historical reality.
Okay, so sticky wages. That makes intuitive sense in a lot of real-world scenarios.
Yeah.
But how does that stickiness translate into the pro-cyclical dividends we need to solve the puzzle? This is where the magic happens, right?
This is indeed the critical chain of events that leads to what the authors call the magnified procyclicality of profits.
Magnified procyclicality.
Okay.
Imagine a negative shock hitting the economy. Let's say a sudden drop in overall productivity. Output, naturally, falls. But because of wage inertia, because wages are sticky, they don't fall as much, or at least not immediately. What this means is that the portion of output going to profits, which is total output minus the relatively inflexible wage bill, shrinks disproportionately more than output itself.
Profits, therefore, become more procyclical and significantly more volatile than overall output.
It's like a small business owner whose revenue suddenly drops, but their biggest fixed cost, their payroll, stays stubbornly high. Their profit margin just gets absolutely crushed, far more dramatically than the initial drop in sales. That's a perfect analogy for operating leverage.
That's a perfect analogy and a very relatable one. And this magnified procyclicality and volatility of profits is powerful enough to overcome the procyclicality of investment and even the costs associated with posting job vacancies.
So it dominates those other effects.
Exactly. The cumulative result. Procyclical dividends. This is the key that unlocks the equity premium. Dividends in this model are shown to fall sharply and dramatically in bad economic times, providing precisely that crucial risk exposure that investors demand to be compensated for with a higher premium.
That's a truly powerful insight. So if sticky wages are the secret sauce that flips the script on dividends, making them risky enough to explain the equity premium, can we quantify just how dramatically this mechanism plays out? What do the impulse responses, those simulations of an economic shock, actually reveal in the model?
Yeah, the paper provides vivid illustrations that really bring this mechanism to life. Consider a negative productivity shock, a sudden economic downturn. In a median economy state within the model, output might fall by 1.5% upon impact, but because of inertia, wages only decline by a modest 0.4%.
Tiny wage drop compared to output.
Very small. This disproportionate fall in output relative to wages causes profits to drop much more significantly by 4.6%. And even with total investment costs falling, the impact on dividends is stark. They plunge by 4.78%.
Okay, so already a bigger drop in dividends than output.
Right. But what's truly striking is what happens in a bad economy state, for example, at the 10th percentile of the model's stationary distribution for employment, capital, and productivity. Basically, when things are already tough, here, a negative shock could lead to output falling by a maximum of 3.77% over approximately 2 years. Crucially, wages remain virtually constant during those 2 years, barely budging.
Wages just don't move.
Almost frozen. Because wages are so sticky, profits drop dramatically, reaching a maximum decline of 7.31%.
It's double the output drop.
Roughly, yeah. Despite investment costs also falling to some extent, the combined effect leads to a staggering 17.7% drop in dividends in a bad economy.
Wow, nearly 18% drop in dividends from less than a 4% drop in output.
Exactly. This vividly shows how wage inertia, by acting as a fixed cost, amplifies financial risks, making dividends far riskier and more volatile precisely when times are toughest. This is the source of the equity premium.
And does this mechanism, this procyclical behavior of dividends, align with real-world historical data? Do dividends actually behave this way?
Yes, it does, broadly speaking. Historical data from those 17 countries confirms that dividends are indeed largely procyclical, showing an average correlation with output of 0.11.
Positive correlation, so they move together.
Right. The model successfully reproduces this procyclicality, albeit with a higher correlation of 0.95.
Okay, much higher in the model. Why the difference?
Well, the researchers acknowledge this quantitative difference, noting that it could be due to the real world experiencing multiple diverse shocks, whereas the model primarily features a single productivity shock. That could dampen the correlation in reality.
Makes sense. The real world is messier.
Exactly. Furthermore, the model's definition of dividends conceptually aligns with net payouts, which include share repurchases, while much of the historical data refers specifically to cash dividends, and a comprehensive historical sample of net payouts across 17 countries isn't readily available.
Data limitations, okay.
Nonetheless, the core mechanism of generating procyclical dividends falling sharply in bad times is robustly supported and represents a major breakthrough.
That magnified procyclicality of dividends due to wage inertia is truly groundbreaking, offering a clear resolution to the equity premium puzzle. But the research also touches on another concept that sounds a bit unsettling: endogenous disasters. What exactly are these, and how do they factor into this unified theory? These sound like they're not just random acts of God, but something more deeply embedded in the system.
Yeah, this raises an important and somewhat chilling question, and it's a truly remarkable and innovative feature of this search model. It naturally gives rise to endogenous disasters.
Generated from within the economy.
Exactly. These aren't just external random shocks like a sudden natural catastrophe or a meteor hitting the Earth. They are severe systemic economic breakdowns that originate within the labor market frictions themselves.
How does that work? How can the labor market cause a disaster?
Well, think of a scenario where a negative shock hits, leading to initial job losses. Because of the search frictions, it takes time to find jobs. Time for firms to hire these job losses are not quickly reversed. Unemployment persists, leading to a drop in aggregate demand, which then further discourages firms from posting vacancies and hiring, leading to even more job losses.
A vicious cycle.
It becomes a severe, self-reinforcing downward spiral, a kind of internal collapse or a run on the labor market, if you will.
So it's not a question of if an external disaster happens, but how the economy's internal mechanics, specifically these labor market dynamics, can generate one from within. The system itself is capable of creating these catastrophic events.
Yeah, precisely. And these consumption disaster risks play an absolutely crucial role in explaining the high equity premium in the model. As previous research, such as by Petrosky-Nadeau et al., 2018, has shown even in a baseline search model without capital, disaster dynamics can arise naturally.
So it's not entirely new, but this model integrates it differently.
Right. Here, with the added layers of capital accumulation and recursive utility, the mechanism is even more profound for generating asset price anomalies and understanding risk. It's the deep uncertainty surrounding these internally generated severe downturns that drives investors to demand a higher premium for holding risky assets.
So the model predicts these self-generated disasters. How well does that prediction actually match up with historical realities when we look at past economic downturns? Did these things actually happen?
The researchers put this to a rigorous test by applying the Barrow and Ursua 2008 peak-to-trough method to historical consumption and output data from that century-plus span, 1871-2015. This method identifies periods where cumulative declines in consumption or output exceed a certain threshold, say 10% or 15%.
Okay, looking for big drops.
Exactly. What's truly fascinating here is how closely the model's predictions match these historical consumption disaster dynamics. For a 10% decline hurdle, the historical data reveals a consumption disaster probability of 6.4% per annum, an average size of decline of 23.2%, and an average duration of 4.2 years.
So about a 6% chance each year of a big consumption drop averaging 23% over 4 years.
That's the historical average, yes. And the model's predictions are strikingly similar and statistically insignificant from the data. A 6.66% probability, an average size of 23.7%, and an average duration of 4.1 years.
Wow, that's incredibly close, almost spot on.
It is an excellent, almost uncanny fit for how consumption behaves during these catastrophic events, offering strong empirical validation for the model's internal disaster-generating mechanism.
That's quite an achievement, matching the frequency and severity of these deep consumption contractions so closely. What about output disasters, like GDP contractions? Does it match those too?
For output disasters, the model tends to overshoot the probabilities somewhat. For example, at a 10% decline hurdle, the model predicts an 11.45% probability of an output disaster versus 5.78% in the historical data.
So it predicts output disasters more often than they happened. Why?
Well, this is largely expected and understandable. The model is primarily designed to match consumption dynamics, as consumption directly impacts individuals' welfare and, therefore, asset prices.
Right, consumption is what people ultimately care about.
Exactly. It abstracts from certain real-world factors, such as large-scale wartime government purchases, which can significantly distort the relationship between aggregate output and private consumption. During wars, for instance, government spending can artificially prop up GDP, while private consumption might actually be declining due to rationing or other resource allocation decisions.
Ah, so GDP isn't always the best measure of personal economic pain.
In some situations, yeah. So the divergence in output disasters is not seen as a critical flaw, but rather a reasonable simplification given the model's focus on consumption and welfare.
This sounds like it also fundamentally challenges some common assumptions in finance, particularly those underlying long-run risks models, about how consumption growth drives the equity premium.
It absolutely does. The model's findings about consumption dynamics differ significantly from prominent long-run risks models, such as those introduced by Bansal and Yaron, 2004. These models attribute the equity premium primarily to highly persistent expected consumption growth.
Meaning that changes in growth expectations stick around for a long time.
Right. The idea is that small shocks to expected growth are assumed to linger for a very long time, creating long-run uncertainty. However, when the Bansal-Yaron process is fitted to this model's simulated data, the persistence in expected consumption growth is only 0.353.
0.353 compared to what in those other models?
This is substantially lower than the 0.979 typically calibrated in the long-run risks literature.
Wow, that's a massive difference. So this model says consumption growth isn't that persistent.
Not nearly as persistent as those models assume, no.
So if it's not these highly persistent long-run consumption growth risks that are the primary driver, what is it that's truly explaining the equity premium in this framework?
This is a major aha moment and a critical distinction. It means that long-run risks, in the sense of highly persistent expected consumption growth, are not the primary driver of the equity premium in this model. Instead, it's the endogenously time-varying volatilities of consumption, which naturally arise from the search frictions and the internal dynamics of the labor market that are crucial.
Time-varying volatility, meaning the riskiness itself changes over time.
Exactly. These time-varying volatilities, which reflect the changing probability and severity of sudden internally generated economic downturns, can be observationally equivalent to consumption disaster risks. It's the occasional, severe, unpredictable, and internally generated economic contractions that truly drive the risk premium, not just the slow, persistent changes in expected growth. It's about tail risk and the fear of a crash, rather than just persistent slow growth.
Okay, that makes sense. It's the chance of a big drop, not just slow growth forever. And if those endogenous disasters are so real, So fundamental to the system, it must have truly profound and potentially staggering implications for how we calculate the welfare cost of business cycles.
This is indeed where it gets truly unsettling and represents one of the paper's most dramatic findings. The model calculates the welfare cost of business cycles, which is conceptually the amount of consumption an individual would be willing to give up, on average, to live in a hypothetical economy completely free of economic fluctuations.
And how much would you pay for perfect economic stability?
Essentially, yes, the model's revelation is an immense average welfare cost of business cycles, a staggering 33.6%.
33.6% of consumption. That sounds almost unbelievable. For perspective, how does that compare to previous widely accepted estimates?
It is indeed an almost unbelievable figure. To put this in stark historical context, this number is more than 670 times Lucas's widely cited 2003 estimate of 0.05%.
0.05% versus 33.6%. That's orders of magnitude different.
Absolutely. Lucas's seminal work suggested that the welfare gains from perfectly stabilizing business cycles were almost negligible. This dramatic difference highlights the profound impact of these endogenously generated disaster risks, which Lucas's framework did not fully capture. The true cost of economic instability, particularly the risk of these internal collapses, is orders of magnitude higher than previously believed.
So avoiding recessions, especially these deep ones, is vastly more important than we thought.
That's what this implies, yes. The model also finds this welfare cost to be significantly countercyclical, meaning it's substantially higher during bad economic times. People are willing to pay even more to avoid instability when they're already in a downturn.
That makes intuitive sense.
Yeah. Furthermore, its distribution has a long right tail, indicating that in some severe scenarios, the welfare cost can be truly immense, with, for example, the 95th percentile reaching 63.3%.
63%. Wow. That implies a fundamentally different perspective on the urgency and nature of macroeconomic policy. It's not just about smoothing out small bumps in the road, but actively mitigating these potentially catastrophic internal risks.
It completely reframes it. This profound implication suggests that policies aimed at dampening these disaster risks are far more important and carry far greater welfare benefits than previously understood, given the immense costs they impose on society. It suggests a much stronger rationale for robust stabilization policies, not just to mitigate average fluctuations, but specifically to prevent these rare, severe, internally generated breakdowns that have such a devastating impact on well-being. #5. Unpacking the asset pricing and macroeconomic fit.
That 33.6% welfare cost is truly eye-opening and definitely gives us pause. Now let's turn to how well this sophisticated unified model actually performs when you compare its quantitative predictions to real-world historical data, both for asset prices and macroeconomic indicators. Does it actually deliver on its promise to explain both simultaneously? Does it walk the walk?
It performs remarkably well, demonstrating a high degree of quantitative alignment, especially considering the ambitious goal. Let's look at the key asset pricing moments first, drawing from Panel E of Table 4 in their study, which averages across the 17 countries and over a century of data.
Okay, the numbers.
For the equity premium, the historical data shows 4.36% per annum. The model's prediction is remarkably close at 4.27% per annum.
4.27 versus 4.36. That's incredibly close.
It is an excellent fit, with the historical data falling squarely within the model's 90% confidence interval. This clearly shows the model's success in resolving the equity premium puzzle quantitatively.
So on that core puzzle, it's a bullseye. What about stock market volatility, which is another crucial measure of risk? How wild are the swings?
For stock market volatility, the historical data averages 16.04% per annum. The model predicts 12.42% per annum.
Okay, a bit lower than the historical average.
Sure.
12.4 versus 16.
It is slightly lower than the cross-country average, yes, but this is still a very significant improvement over prior general equilibrium production models, which often struggled to generate anywhere near this level of volatility. And importantly, if we look specifically at the U.S. historical volatility, which is 13.66%, that falls comfortably within the model's 90% confidence interval.
So it matches the U.S. experience reasonably well.
Yes. So it provides a very plausible and empirically grounded representation of how volatile equity markets actually are, even if it's slightly low on the cross-country average.
And average real interest rates, a key component of asset pricing. The risk-free rate, basically.
The average real interest rate in the historical data is 0.82% per annum, and the model predicts 1.97%.
Okay, model's a bit higher there, almost 2% versus less than 1%.
Right. While slightly higher than the historical average, it's still well within a plausible and economically reasonable range for what you might expect from a long-term, risk-free real interest rate in a stable economy. However, there is a notable mismatch in interest rate volatility.
Ah, the volatility again. How big is the difference here?
The historical data shows an average volatility of 7.3% per annum, but the model predicts only 2.47%. This is a significant underprediction.
Yeah, that's quite a gap. 7.3 versus 2.5? Is that considered a fatal flaw, or is there a good explanation for why the model struggles there?
It's generally considered an acceptable trade-off, given the comprehensive success elsewhere. The researchers point out that the model, by design, doesn't account for extreme historical events like sovereign default or hyperinflation, which historically drove very high interest rate volatilities in some of the included countries, such as Germany, Italy, and Japan, during periods of immense economic and political upheaval.
Right, those crazy periods mess up the averages.
Exactly. In the U.S., where such extreme events were less prominent over the long run, the historical volatility was a much lower 4.65%. Even this is still a bit higher than the model's prediction, but it's much closer, indicating that for economies with more stable monetary and fiscal policies, the model's performance is more aligned.
Okay, so it misses some historical extremes, which makes sense given the model's focus.
Right. So it's a known simplification, but not one that undermines the core insights about equity risk.
So on the asset pricing side, a very strong overall fit with some understandable limitations for interest rate volatility, particularly for countries with more volatile histories. What about the macroeconomic side? Does it retain plausible business cycle dynamics, or does fitting the equity premium distort the real economy?
This is where the unified aspect really shines. The model manages to achieve this asset pricing fit without sacrificing its macroeconomic realism.
That's the hard part, getting both right.
Absolutely. If we look at the key macroeconomic moments from panels A, B, and D of Table 4, the consumption growth volatility is nearly a perfect match. The model predicts 5.43%, while the data shows 5.45%.
Wow, spot on for consumption swings.
Pretty much, yeah. This is remarkable. For the mean unemployment rate, the model's 9.4% is very close to the historical average for private non-farm unemployment in the U.S. from 1890 to 2015, which was 8.94%.
Again, very close on average unemployment.
Yes. The model also does an excellent job of matching higher order moments, like the skewness and kurtosis of unemployment rates, meaning it accurately captures not just the average, but the full distribution of unemployment, how often you get really high or really low rates.
So it feels like a realistic economy.
Exactly. It's not merely an asset pricing model, it's also a robust macroeconomic model that successfully replicates the observed characteristics of business cycles.
That's a true intellectual feat. But does this model also offer us something practical? Can it give us insights into market predictability? Can we, as investors or policymakers, read the economic signals to anticipate what the market might do?
This is where it gets incredibly valuable for both investors and policymakers. The model implies strong predictability for stock market excess returns and stock market volatility.
Predictability. Okay, now you have my attention.
Right. It also suggests some predictability for consumption volatility, but weak to no predictability for consumption growth and the real interest rate.
So predicting stock returns and volatility, yes. Predicting consumption growth, not so much.
That's the gist of it. And the mechanism behind this predictability is entirely consistent with what we discussed earlier. That critical concept of wage inertia, particularly its time-varying nature.
Okay, let's unpack this. How exactly does wage inertia lead to this predictability? What's the link?
Well, as we said, wage inertia creates what's known as operating leverage. In bad economic times, when, say, a negative productivity shock hits, output falls. But because wages are sticky, they don't fall commensurately.
Right, profits get squeezed hard.
Exactly. This means that the portion of revenue that goes to profits drops even more disproportionately. This dramatically magnifies the procyclical dynamics of dividends, making them riskier. Consequently, the expected equity premium rises in bad times to compensate investors for this heightened risk.
So when things look bad, expected future returns go up.
That's the idea. Crucially, this time-varying wage inertia is stronger when the economy is already in a weak state, i.e. low productivity, further amplifying perceived risks and demanding higher risk premiums. The consequence is that the expected equity premium and stock market volatility become countercyclical.
Countercyclical,
Yeah,
meaning they go up when the economy goes down and vice versa.
exactly.
So if I'm understanding this correctly, it means when economic conditions are looking particularly grim, the expected future returns on stocks are actually higher because the market is demanding greater compensation for bearing that elevated risk of an endogenous disaster. It's the market correcting itself, in a way, pricing in the true cost of uncertainty.
Exactly. It's the market rationally pricing in that heightened risk of endogenous disasters. And the empirical support for this mechanism is quite compelling. Long horizon regressions using historical cross-country data detailed in Table 7 of the paper confirm this.
What does those regressions show?
They show that the log price-to-consumption ratio is a strong predictor of future stock market excess returns.
Price to consumption, like a valuation metric.
Yeah, similar to price to earnings or price to dividend, but using aggregate consumption. The slopes of these regressions are largely negative, meaning high stock prices relative to consumption predict lower future returns, while low prices predict higher future returns and are often statistically significant.
So buy low, sell high has some theoretical backing here.
In a sense, yes, linked to these risk dynamics. The R-squared values for these predictions, which indicate how much of the future variation is explained, range from 1.87% to 9% for 1 to 5 year horizons, which is quite substantial for financial markets.
9% predictability over 5 years. That's pretty significant.
It is. In fact, the U.S. actually shows some of the strongest predictability in the entire data set. For predicting consumption growth with price to consumption, however, the evidence is much less consistent and generally weaker, just as the model suggests.
Okay.
So this model truly helps us understand not just what the equity premium is, but why it fluctuates over time and why we might be able to predict future returns, especially over medium horizons.
This unified view, especially the role of wage inertia and the very real threat of endogenous disasters, dramatically reconfigures how we think about risk and return in the stock market. But does it have implications beyond just the equity premium? What about the bond market, specifically the real yield curve? Does it say anything about interest rates for different time horizons?
Yes, absolutely. If we connect this to the broader financial landscape, the model certainly does have profound implications for the term structure of real interest rates. It predicts a downward sloping real yield curve.
Downward sloping. Wait, usually we hear about upward sloping yield curves.
Usually for nominal curves, yes. But here, for real, inflation-adjusted yields, the model predicts the opposite. This means that long-term, real zero-coupon bonds, those that promise a fixed amount in real inflation-adjusted terms at maturity, should consistently offer lower yields, on average, than short-term real bonds.
So holding a bond for, say, 10 years, in real terms, would actually give you a lower average annual return than continually rolling over short-term real bonds. That seems counterintuitive to many people's experience with nominal bond markets, which are often upward sloping.
It can indeed seem counterintuitive if your primary reference is the nominal yield curve. But in this model, for real yields, that's precisely what's predicted, and it's driven by a powerful hedging mechanism.
Okay, what are the numbers here?
In the model, the yield to maturity for a 1-month bond is predicted at 1.92% per annum, but it steadily falls to 0.59% for a 10-year bond.
Almost 2% short-term, down to just over 0.5% long-term.
Right. This results in an average yield spread of Nagata's 1.33% and a real term premium of Nagata's 1.55%. So yes, the model suggests a significant negative real-term premium, meaning investors are willing to pay for the privilege of holding longer-dated real assets.
So what's the fundamental intuition behind this seemingly unusual downward slope for real yields? Why would investors accept less for holding a bond for longer, in real terms? What's the hedge?
The core intuition is that these long-term bonds serve as a powerful hedge against those very disaster risks we discussed.
Ah, the endogenous disasters again.
Exactly. During severe economic disasters, those endogenous downturns originating from within the labor market, a wave of panic sets in. There's a desperate flight to safety, and people drastically increase their precautionary savings.
Everyone wants safe assets.
Right. This surge in demand for safe assets, in turn, drives down real interest rates across the board and significantly pushes up the prices of those safe assets. If long-term bonds are among those assets whose prices tend to rise precisely at the onset of these economic disasters, they offer crucial protection and diversification when the rest of an investor's portfolio, particularly equities, is likely plummeting.
So you pay for safety when you need it most.
Precisely. Investors are, in essence, paying a premium for disaster insurance by accepting a lower average long-term real return because that insurance pays out in the form of capital appreciation and safety when it's most desperately needed. They value the hedging property more than the average yield.
That makes profound sense. It's valuing safety and stability above all else during a crisis. Is there any real-world evidence for this downward-sloping real yield curve? Or is it purely theoretical? Do we see this in TIPS or index-linked gilts?
The evidence is somewhat mixed, partly because these markets are younger than nominal bond markets, but generally supportive. Data from the United Kingdom's inflation-indexed gilt market, which has a relatively long history stretching back to 1982, generally supports a downward-sloping real yield curve, especially when considering the true long-term yields.
Okay, so the UK data fits. What about the US?
In the United States, the Treasury Inflation-Protected Securities, or TIPSES, market started in 1997, so the data sample is much shorter. While the TIPS yield curve sometimes appears upward sloping, particularly in shorter-term segments, this can often be attributed to liquidity issues in the nascent market or specific short-term market dynamics rather than a fundamental long-term real-term premium.
The market structure issues might confuse the picture.
Possibly, yeah. Over longer horizons and with more mature markets, the evidence leans towards this model's prediction of a flat or downward sloping real curve.
And it's absolutely crucial to remember that we're talking about real yields here, not the nominal yields that most people are familiar with from their daily news feeds, right? This isn't about the Fed funds rate versus the 10-year Treasury note yield directly.
Absolutely. This is a critical distinction that cannot be overstated. A downward-sloping real yield curve, as predicted by this model, does not contradict an upward-sloping nominal yield curve, which is indeed what most people are familiar with. Nominal bonds are subject not only to real interest rate risk, but also to inflation risks, which are not explicitly included in this model.
So inflation expectations mess with the nominal curve.
Right. A positive inflation risk premium, where investors demand more compensation for the uncertainty of future inflation, especially over longer horizons, would typically lead to an upward-sloping nominal yield curve, even if the underlying real yield curve is flat or downward-sloping. This model focuses purely on the fundamental real components of risk and return, divorcing it from the complexities of monetary policy and inflation dynamics. Hashtag outro.
Wow, what a deep dive. We started with a long-standing, seemingly intractable mystery, the equity premium puzzle, and through the lens of a truly sophisticated and innovative new model, we've seen how integrating labor market dynamics, specifically the profound impact of wage inertia with capital accumulation, well, it doesn't just solve that puzzle, but offers a unified, coherent, and often unsettling picture of our entire economy.
Indeed. It's not merely an incremental adjustment. It's a complete reevaluation of how risk propagates through the economy, how it's truly generated internally, and ultimately how it's priced into financial assets. It connects so many dots.
For you, the listener, here are some key takeaways that I hope will truly resonate and spark further thought. First, the surprising and truly powerful role of wage inertia in magnifying corporate profits pro-cyclicality, thereby making dividends sufficiently risky to explain the equity premium.
Yeah, that wage stickiness is huge.
It's a fundamental mechanism hiding in plain sight. Second, the profound reality of endogenous economic disasters, not just external shocks, but severe, systemic breakdowns originating within our own labor markets.
The idea that the system can generate its own crises.
This insight alone is a huge revelation about the nature of economic instability. And then, there's the truly staggering welfare cost that these business cycles impose on us, not the negligible 0.05% that was widely accepted, but a monumental 33.6%.
I mean, that number is just stunning when you think about it.
It really is. This isn't just theory. It's a reevaluation of risk itself, a powerful call to rethink how we understand and manage economic fluctuations.
And this research fundamentally reshapes how we view financial markets and macroeconomic policy. This raises an important question. If the true welfare cost of business cycles is 33.6%, an almost unbelievable figure compared to prior estimates, what kind of proactive, far-reaching, counter-cyclical policies should we be pushing for to mitigate these disaster risks?
Right. Does it change the calculus for policymakers?
It suggests a far greater urgency for robust stabilization policies, potentially involving automatic stabilizers or new labor market interventions than previously understood. It challenges us to think differently about the very role of government in managing economic stability.
And for you, the individual investor, what does this deep understanding of endogenous disasters, of this countercyclical nature of risk premiums mean for your own long-term investment strategy?
Yeah, how do you apply this?
Does it change how you assess risk in your portfolio? Knowing that the biggest risks might come from within the system, and that expected future returns might actually be highest when times are toughest, when everyone else is panicking. It's a profound thought that asks us to reconsider not just what we invest in, but when and perhaps why.
Food for thought, definitely.
Thank you for joining us on this deep dive. We hope this exploration empowers you with knowledge that goes far beyond the headlines, helping you see the interconnectedness of our financial markets and our real economy with newfound clarity. Stay curious, stay informed, and we'll see you next time.